It's pretty amazing how one single day can tell such a huge story about the global economy. And that's exactly what happened on February 5th, 2026. It was a day the market basically fractured, splitting right down the middle. While one half of the world seemed to be in a nosedive, the other half was, believe it or not, just starting to find its feet. So today we're going to unpack this tale of two markets and figure out what it's really telling us about the year ahead.
And yeah, this really paints the picture, doesn't it? On one side, you've got total turmoil, storm clouds gathering over the whole global tech sector, driven by a wave of fear. But then, on the other side, you have a completely different story unfolding. The sun's kind of starting to peek through for South Africa's economy as it finally hits stable ground. I mean, these are two starkly different worlds happening at the exact same time.
All right, so let's start with the chaos. A literal tidal wave of selling kicked off in the Asian markets and then just swept its way across the globe, crashing right into one of the market's most sensitive spots: technology.
So what exactly lit the fuse on this tech tumble? Well, it was really a perfect storm. You had investors getting super jittery about these sky-high valuations for tech companies, especially with all the talk about the massive and, let's be honest, uncertain costs of building out all this new AI infrastructure. A few so-so earnings reports were really all the excuse the market needed, and bam, suddenly major indices in Japan and South Korea were just falling off a cliff. Now, this kind of fear, it doesn't just stay in one little box. It creates what traders call a risk-off mood. And you can think of that as someone hitting the global panic button. All of a sudden, investors are selling anything that looks even a little bit risky and just scrambling for safety. That anxiety became really contagious, spreading way beyond just the stock market. And if you want a perfect example of just how widespread this fear was, just look at crypto. In just the week before, $500 billion was wiped from the market's value. That's $500 billion, gone. It was just a brutal reminder of how quickly the tide can turn when it comes to the market's riskiest assets. And here's where you really see that domino effect in action. When investors get nervous about economic growth, they assume, hey, we're going to use less energy, right? So boom, oil prices fall. Even things that are supposed to be safe havens, like gold and silver, took a pretty big hit. And currencies that are tied to global trade, like the Australian and New Zealand dollars, they weakened too. It was this interconnected web of anxiety, and pretty much everything got tangled up in it. Okay, so take a deep breath, because while all of that red was flooding the screens, a completely different and, frankly, much more hopeful story was taking shape thousands of miles away in South Africa. So, to really get why this is such good news, you've got to understand this one key number, the PMI, or Purchasing Managers' Index. Just think of it like a monthly report card for a country's private sector. If the score is below 50, the economy is shrinking. If it's above 50, it's growing. That makes 50 the magic number. It's that exact point where things stop getting worse and start to stabilize. And there it is, 50.0. For the first time in months, South Africa's private sector wasn't shrinking anymore. After a really long, sluggish period, the economy had finally hit its balance point. And for them, this was a huge, huge sign of encouragement.
So, what was the secret sauce here? What drove this turnaround? Well, it came down to a few really key things. Businesses started seeing more new orders coming in, so they ramped up their output. The local currency, the rand, actually got stronger, which helped ease cost pressures by making imports cheaper. And, maybe most critically, the energy grid became more reliable, which meant businesses could actually operate without constant interruptions. That alone boosted confidence across the board. So, you have these two powerful opposing stories, right? A global tech sell-off and a stabilizing regional economy. And who's stuck in the middle trying to make sense of it all? Yep, the world's central banks. They were all pretty much in a wait-and-see mode, just watching from the sidelines.
And this table just lays it out so clearly. Look at the policy stance across the board. Hold, hold, and hold. In the Eurozone, inflation was cooling down, so they decided to wait. In the UK, it was still a little sticky, so they waited, but cautiously. And in South Africa, trying to balance that fragile new growth against old inflation fears, you guessed it, they also waited. The message from policymakers everywhere was unanimous. Don't make any sudden moves. And this number right here, this is what that hold looks like in practice for South Africa. They kept their main interest rate steady at 6.75%. And why? Well, it's a total tightrope walk. If you raise rates, you could snuff out that fragile recovery before it even gets going. But if you cut them, you might let inflation get out of control again. So they held steady. Okay, so let's zoom out and pull all of these different threads together. We've got a tech wreck, we've got a surprising stabilization story, and we've got a bunch of cautious central bankers. What does it all tell us about the state of the global economy on this one very polarized day?
This quote, I think, just hits the nail on the head. It talks about balancing macro fundamentals, that's the real stuff, the actual economic data, against valuation and sentiment, which is really just the market's mood, all the fear and the hype. It's a fancy way of saying there's a huge tug-of-war going on between hard facts and, well, feelings.
So this all boils down to three key dynamics playing out at once. First, investors were basically rethinking the entire future of tech. What's it really worth? Second, inflation was finally cooling off, which gave central banks some breathing room, but it didn't mean they were ready to start cutting rates. And third, you had this glimmer of hope coming out of South Africa, a bit of cautious optimism and what felt like a sea of uncertainty.
And this slide puts that core conflict right in front of you. On the left, you've got the real economy, the hard data, like that South African PMI number. And on the right, you've got the market's mood, the tangled mess of hype and fear that was driving the tech sell-off. The entire global economy was basically caught in the middle of this massive tug-of-war.
And after all of that, it really leaves us with one giant question hanging over the rest of the year. On this one day, we saw two totally different stories. Weakness in the high-flying world of tech, but surprising strength in the nuts and bolts real economy. So which of these two stories is going to win out and define 2026? Well, that's the story everyone is now watching.